Assalamu alaikum everyone, this is Abdulaziz. Today we will talk about double entry bookkeeping, the second lesson of our financial accounting courses. First of all, before talking about double entry bookkeeping, we should be aware of source documents used in sale and purchase process. First of all, purchase requisition and also quotation. I think quotation comes first. If you don't have quotation or if you are in good relationship with a supplier, you don't need quotation. I think that uh, quotation is the quantity and description of the goods required or to establish price. Actually, quotation is the information about the goods that the supplier have in its inventories. After that, purchase requisition. Purchase requisition is completed by an employee of the customer and after that, this is the information about the goods required. A purchase order. This is sent to the supplier by the customer as an order for the purchase. After that, the seller issues sales order for its inventory for the processing the goods. It is about the quantity of the goods and also amount required. And the price. Debit note. Not debit note. Dispatch note. We have the dispatch note. Dispatch note is the information about the goods being delivered by the supplier. After that, as soon as the customer receives the goods and it checks if the goods are correct, it issues goods received note like this. I am delivering these goods to you, and if the customer receives goods, it issues I receive it, and it says I receive it by goods received note. And another one is sales invoice. Sales invoice. It is issued by the supplier as a request for the payments for the goods delivered, which is purchase or supplier invoice. Sales invoice is received by the customer as a purchase invoice. Then the next one is about debit note. Debit note is information about the goods that are being returned. For against the debit note and for against the goods returned, supplier issues credit note by reducing the payables of the customer. Supplier statement. Supplier statement is the account of the customer in the journal of the supplier, which summarizes transactions with the customer, like date, invoice, payments, and amount of it. The remittance advice. Remittance advice is issued by the customer as a proof for the payment and sent to the supplier. If the supplier received the payment, it issues receipt. That's all. That's it. After that, let's talk about the principles of double entry bookkeeping. Principle of the double entry bookkeeping is dual effect of any transaction in the business. Any transaction in the business has a dual effect. Let's say examples. There is one person named Lee commencing the business as a sole trader and paying $1,000 into a business bank account. The dual effect of this transaction is the business has cash at bank at $10,000. The business owes a proprietor return of $10,000 equity or capital. Lee paid rent of $1,000 for the business. As is incurring expense account increases by $1,000. Cash at bank increased by $1,000. Lee purchased goods for resale, paying $2,500 immediately. The dual effect. As it's purchasing goods, incurring expense, purchase expense increased by $2,500. Cash at bank decreased by $2,500. Lee sold some goods to a customer for $4,000 who agreed to pay at a later date. The dual effect is the receivable. As the amount is not received by the customer, it records receivable. Increased by $4,000. Sales increased by $4,000. If this is understandable, we will go through the basement of accounting equation. Total assets equals total liabilities plus equity. Asset, present economic resource controlled by an entity as a result of past events. Example for the assets: cars, property, plant and equipment, building, cash, inventory, and receivables. Liability, present obligation of the business to transfer an economic resource as a result of past events. Examples of liabilities: loan payable, tax payable, overdraft. Right? Asset is what the company has, or liability is what the company owes to a third party. Equity is the residual interest in the company after assets less total liabilities. This means the difference between total assets and total liabilities, which belongs to the owners of the company, investors, co-founder, and so on. Share capital, share premium, retained earnings are examples for equity. Okay, let's go through some examples in your study text. Okay, right now we have 6 examples in your study text for the accounting equation. There is one person, Ali, also commencing the business with introduction of $1,000 cash. Okay, if there is $1,000 cash introduced by the founder, what increases? Yes, it has $1,000 cash asset and owes the owner $1,000 is capital or equity. You see, assets increasing by $1,000 and equity is increasing by $1,000. Paid rent by $350,000, 350, right? Dollars. Increasing, incurring the expense. That's why reduced cash by $350. Expense reduces equity by 350, the same amount. That's why assets and equity equals, right? Okay, you will see the other examples by yourself, and let's continue our lesson. Okay, we have 3 systems in accounting: inputs, processes, and outputs. Inputs, in short, providing proof of financial transactions: sales invoice, purchase invoice, on bank statement, standing data, and so on, right? And process, converting data into accounting format to ensure accuracy. You may make journal entries to correct your errors, or ledger postings for calculations, or you may check also trial balance to check the accuracy, mathematical accuracy. If the balance, trial balance means balance, right? The debit and credits should be equal. You will see what is debit and credit. Outputs in accounting. What is output? Providing information to users or management investor for decision making, right? It means making financial statements or management reports, or also producing trial balance, if this is correct. We have developments in accounting, cloud accounting, and cloud computing. What is cloud computing and accounting overview, right? What is it? Cloud computing is the server ensures the access of the employer or users remotely. Cloud accounting is a software runs on the cloud, right? Single desktop. You see? Okay, what are the benefits of the cloud accounting? Real-time access from anywhere if you have the account, or automatic data backups. Improved collaboration, multiple users can connect it, and lower IT costs. Fewer physical servers, automatic updates, and so on. As it can be accessed through the anywhere, it depends on the internet, right? If you don't have the internet, you cannot access the cloud account. Security risks. Sometimes there may be cyber attacks to the account or the account of the users. Monthly annual costs you need to pay. Monthly annual costs for the cloud accounting. Limited control or customization. You have the limited control because someone may destroy everything that you have done. This is a picture for the global cloud account system, right? Banks, different kind of banks, inventories, or your desktop, phone, and others. This ensures that you can enter the or you can access the account from anywhere if you have the account. And also accounting, we have journal and general ledger. What is journal? Journal is book of original entry, chronological order, daily translogs, or there is also the errors. Errors are corrected here, right? Why transactions happened. This gives the reason for the every transaction. General ledger is the accounting set. Yeah, is the all of the information or all of the accounting are summarized in the general ledger. And ledger accounts are the part of the general ledger. Okay, the most important part, debits and credits. They have no meaning. Sorry, it is not bolded. And it's also the to grab your attention, maybe, right? Debits. What are the debits? Debits are assets, expenses, and drawings. Assets and expense drawings are the part of debit side, right? On the right side, credits, liabilities, income, and capital equity. Which side, you may say, or where of the right side? It is a T account, or this is a also the not ledger. Ledgers are prepared by this T account. Why it is T account? Because it likes T. You see, on the left side is debit, on the right side is credit. If you incur expenses or if you have the liabilities, you will write on the credit side, and if you have the assets, you will write on the debit side. This is also the dual effect of any transaction, right? Assets, expenses, drawings are written on the left side, or assets increases. If you want to increase the asset, you need to write it on the left side. If you want to decrease assets, expenses, or drawings, you need to write on the opposite side, credit side. For the liabilities, income and capital and equity, it is the same thing. If it is understandable, we will go through also some examples. Let's see, for example, right? We have the accounting equation. We may write purchases for cash. Now, what we will write on the debit side? Cash is asset. That's why we will write cash here, right? Or we may do it like this: debit. To make more understandable, debit cash, credit. We are purchasing for cash. That's why we have the debit, purchase expense, credit, cash. Why? Because by purchasing on cash, we are decreasing our cash account. And also purchases on credit, we are not incurring. We are incurring purchase expense. Expenses are posted on the debit side. That's why debit purchase, credit. You see, we are purchasing on credit. That's why this means we are not paying the goods. That's why we are incurring. We have the liability of transferring cash in the future. That's why credit liability. You may write or payable, liability or payable. Cash sales, making profit on sale. If you are making sale on cash, this means our cash account is increasing because of our sales. Debit the cash. Why it is increasing? Credit. Income or revenue means sales, right? This is sale. If it is understandable, we will end our lesson. Take care and see ya on our third financial accounting lesson.